As the title says, the journey to heaven, will be diving into heaven of film financing a little more. So this case study gets you a little more into the weeds of how things work in the real world. For example, we're going to be dealing with bank loans that are actually applying interest charges as it is normal. We'll be dealing with investors that will be paid a premium as it is normal. And we will take the next step from net revenues into profit participation payments. So this one has a little more juice, as I'd like to say. Take your time, go through it. If you get stuck or have questions anywhere, feel free to send me an email through Canvas. Enjoy. So we look at a beautiful project, The Journey to Heaven, and we see that our sales estimates at the take level are 75% of our $15 million budget, which is $11,250,000. We also pre-sold 35% of our budget, and that is $5,250,000. For our valuation for this project, we are assuming that we will be selling $5 million to a US distributor for the US distribution rights, and we will sell those after the film has been finished, versus the pre-sales, which are being sold before the film is being produced and the money is used to pay a portion of the production cost. While sales estimates are important, and so are pre-sales, of course, they're not really worth anything until we're able to take them to the bank. Sales estimates are basically pieces of papers, and so are pre-sale distribution agreements. What can we do with that? Nothing. So we'll take it to the bank, and the bank will give us a loan. And that loan looks as follows. The pre-sale distribution agreements are being cash flowed by the bank. So $5,250,000 are given to us as a pre-sale loan. Obviously, we did receive 20% of our pre-sales already, which was a down payment that was given to us by the distributors upon signing of the pre-sale distribution agreements. So this down payment needs to be deducted because we already received it. So the gross pre-sale loan would therefore be $4.2 million. The bank will of course charge us interest, and in this case the bank charges us 5%. The bank will deduct this interest from the gross pre-sale loan amount, which leaves us with $3,990,000 for our pre-sale loan amount. Again, this is the loan that is given to us against our pre-sale distribution contracts. So it's a loan that is backed by distribution agreements. The gap loan is not backed by distribution agreements. The gap loan is simply backed by the rights we haven't sold yet. What have we not sold? Well, if we look at our international sales estimates, which totaled 75% of our budget, and that is $11,250,000. And if we look at the fact that we sold of that $5,250,000, we are left with unsold rights of $6 million. The bank will consider these unsold rights as a collateral, and it will actually lend us 50% of this value, which is $3 million. So our gross gap loan in this case is $3 million. The bank will charge an interest. The interest is higher because there is no distribution agreement against this loan. This is basically an unsecured loan. So the 9% are being charged on the $3 million, which is $270,000, and that leaves us with a net gap loan of $2,730,000. Now, if we add our net gap loan and our net pre-sale loan, we will have $6,720,000 available to us at closing, meaning available to us to cover our production cost. We need to, however, remember that the amount that we have to actually repay to the bank is the gross bank loan, and that is the amount that includes the interest fees, because we haven't actually given the bank a check for the interest. They just deducted it. So when we get to the revenue columns and we get to our revenue and recoupment schedule, this is when we pay back the gross bank loan amount. So let's take a look at our finance sources. What have we gotten so far? Our international distribution revenue projected, meaning our sales estimates, were 75% of our budget. That is 75% of $15 million. They were $11,250,000. This is just a reminder. Now, of these projected revenues, we did actually do sales. We did pre-sales. Again, pre-sales are done before the movie is produced. That's why they're called pre-sales. So we sold to distributors internationally $5,250,000 worth in distribution agreements. Now, these distributors, when they signed the distribution agreement, agreed to an installment plan that says 20% is due on signing the distribution agreement and 80% is due when the movie is delivered. So the distributors are actually paying us 20% at this very moment when they sign the distribution agreement with us. So we have $1,050,000 already from the distributors. So the bank will then deduct this amount from our loan amount because we already received it. So that gets us to the gross pre-sale loan amount of $4,200,000. And of that, we pay 5% interest to the bank, which is $210,000. But we're not actually paying this interest right now. We're not issuing a check to the bank of $210,000. The bank will just deduct it from the pre-sale gross loan amount and will lend us $3,990,000. Now, this is a loan that is against distribution agreement. So there is an actual asset against this loan, which is a distribution agreement, or in this case, many distribution agreements from many distributors that are just all together summing up 35% of our budget. Now, the gap loan does not have distribution agreements against it. The gap loan actually is a loan where the bank looks at the rights that have not yet been sold, therefore called unsold rights. Now, how do we get to that number? Again, our estimated sales, projected sales, or sales estimates were $11,250,000. Of that, we then sold $5,250,000, which leaves us with $6 million in unsold rights in the international market. So the bank looks at that amount and says, I will give you 50% of that as a gap loan. So $3 million would be our gross gap loan amount. The bank will charge a higher interest here because there is no actual asset against it, and therefore the bank charges us 9%. 9% of $3 million is $270,000. So we're left with a net gap loan of $2,730,000. And if we count the net gap loan and the pre-sale loan together, we will end up with a total bank loan net of $6,720,000, which is given to us and made available to us to cover our production cost. What we have to pay the bank back later, however, is the gross bank loan amount, because we do have to pay our interest, and we pay that later in our recoupment schedule. So we'll get to that when we talk about the recoupment schedule. But for now, just remember what you have to pay back is the bank gross loan amount. What you get to use to cover your production cost is the bank loan net. So we did have a production incentive loan. We are shooting in a production incentive region where a 25% rebate is given to us. 25% based on the expenses that we will be incurring in the production incentivized region. The production incentive lender who is willing to cash flow this production incentive to us in advance of the production incentive actually being due, it's not due until we actually shot the movie and we actually made the expenses, but that doesn't help us. We need it now. We need it to actually produce the movie. So this lender will say, I acknowledge that you will be receiving $3,750,000 in a production incentive from the legislation, and I will lend this to you against a fee that I will charge you of 15%. So the production incentive lender charges us $562,500. So we have to deduct this from the production incentive amount of $3,750,000 and are left with $3,187,500. Now, if we add the down payment that we received from our distributors of $1,050,000 and the bank loan of $6,720,000 and our incentive loan of $3,187,500, we get to a subtotal of $10,957,500. Well, that's not $15 million yet, and that's what we need to cover the budget. So the balance is financed by the equity investor, and that balance is $4,042,500, which reflects 26.95% of our budget. So now we have produced our movie and we've sold all our distribution rights. We sold the US distribution rights for $5 million. We sold all our international distribution revenues for $11,250,000. And of course, for our calculation here, we are deducting the amount we already received, which is $1,050,000, which leaves us with a total gross distribution revenue of $15,200,000. Now, what happens with that? Our expenses are being deducted from these revenues. So let's look at what our expenses are. We have a collection agency, which is a third-party agency, and their job is nothing else but to collect all the distribution revenues from all over the world on our movie and put it in one bank account and charge 1% for that, because their job is then also to pay all the expenses and all the repayments to the bank and to our equity investor. That's their job. Their job is to manage all the revenues and all the expenses and all the repayments. And for that, they charge a 1% fee, 1% of whatever hits the collection account. And what hit the collection account was the total gross distribution revenue of $15,200,000. 1% of that is $152,000. Next, we're paying our distribution fees and expenses. The sales agent sold the international rights, which were $11,250,000. And for that, it gets a 16% fee, 15% distribution fee, 1% distribution expenses, so it's 16%. That is $1,800,000. The U.S. agency who sold the U.S. rights charges us 5% for that, and 5% of $5 million is $250,000. The bank loan is being repaid next. That's our gross bank loan of $7,200,000. And then our equity is being paid. That was $4,042,500. The equity investor is charging us a 20% premium. 20% of $4,042,500 is $808,500. So altogether, if we sum up all our expenses, we have to pay $14,253,000. And if we deduct $14,253,000 from our revenues, which was $15,200,000, we are ending up with a net profit of $947,000. And during the last step, we have to pay our profit participations. Now, these profit participations are agreed with our equity investor and our cast and director. The equity investor is getting a standard 50% of the percentage he has invested in relation to the budget. Remember, the equity investor invested $4,042,500, which was 26.95%. So altogether, he would get 13% as a back-end profit participation, which is about 50% of that, if you round it up. The cast and director each are getting 20%, so altogether, they're getting 40% of our profit participation. And once we sum this up, we, the producer, are left with $440,000, $591.75.